All right, we're live. Hey, it's Mitch Goldberg. You're watching Be the Boss of Your Money. We talk about personal finance, investing, the stock market. We talk about crypto. We talk about pot stocks. We talk about pandemic stocks. We talk about crazy stuff that happens, the crazy stuff that happens in Wall Street. But ultimately, we want a fun, entertaining, and educational way to teach you about personal finance, to make you the best possible version of your financial self. We're going to talk about three stocks of the day: Lululemon. We're going to talk about DocuSign, and we're going to talk about NVIDIA. Popular stocks, they all have a different story to tell, but they all have big moves to reinforce the story that they want to tell. And then we have to always talk about the Fed, the Federal Reserve. We're going to roll a quick intro, and then we're going to have a really good show. It's Thursday, and I typically do the show a little quicker pace on Thursdays because y'all want to get out of here. We're kind of tired, so just do me a favor while you're watching the show. Give us a thumbs up, an applause, a heart, whatever reaction is available to you, depending on which social media platform you're watching from. Reach out to me through social media, or you can reach me in whatever way works for you if you'd like to talk about how my services could possibly help you. And of course, follow me everywhere you can. But if you give us a like, that helps to spread the good word about the show. It helps the algorithm. And if you have any questions, you know, during the show or in the replay, hit me up in the comments. I love hearing from you. It's the best part about doing this. And now we'll roll the intro. Here we go. All right, we're here. Thank you so much for joining me. We're just getting started. My name is Mitch Goldberg. Just call me Mitch. We're talking about money. We talk about stocks. We talk about bonds. We talk about interest rates. We talk about mortgage rates. We talk about everything that has to do with money here. No holds barred. I give it to you straight. Sometimes I'm a little crass, excuse me, but I want to make sure the points that we make here sink in. You know why? Because I've been doing what I do as a financial advisor for over 30 years. I've learned an awful lot, and I want to share the knowledge with you. And I guess, I'm willing to put myself out there on a live platform and actually share the knowledge. And, some people just can't go live. I can do it. But you know what's really cool? When you ask questions in the comments about what we're talking about, I love hearing from you. So please hit me up with your questions in the comments. Give us a thumbs up and help spread the good word about what we're doing here. It's all educational. And let's get into the show. All right. What are you guys thinking today? Is there anything that you want me to talk about? I really would rather take my cue from you. But let me show you a little something first. Okay. And I'm going to do a quick share screen. All right. This is Charlie Brown. And look, this is Charlie Brown is the investors. Lucy, who you'll see, is the Federal Reserve. And the football is interest rates. And let's just take a look at this analogy, okay? There you go. I wanted to show you that. All right. And that is, to me, more or less what investors went through time and time again. The Fed sees inflation. The Fed raises interest rates. The Fed talks tough. Different Fed governors talk tough. Stocks go down. Then somebody gets a little dovish. a Fed governor will say, hey, maybe we've raised rates enough. Last week, Powell sounded dovish and said we're getting to the end of the rope on raising rates. All of a sudden, the market goes up a lot last week. And ever since then, it's done nothing but go down. We just had an update today. We had our worst days-long losing streak in the stock market since October. And what happened? We keep doing this. The market goes down, it goes up, and then the Fed pulls the interest rates or pulls the football away. And we're Charlie Brown. We're running up, and we kick it, and we go flying in the air. And it happened to us again. So what I keep saying on the show is stay cool. Don't get worked up either way. I've always said to you, I post my social media signs. The things I do differently, like when the Dow's up 1,000 points, is nothing. And the things I do differently when the Dow's down 1,000 points is nothing. I invest according to my needs, help my clients do that, and that's all you should be doing. I mean, you're changing your whole portfolio because all of a sudden the market went up a little bit, and you're like, oh, that's it. Now the market's going up, and now I have to, change everything. Oh, and then the next week the market's going down, and you're going to change everything. What a horrible way to invest. And you'll probably lose money on every change you make. Your portfolio will be lower each time. You'll make the change, lock in those new lows in your own account, and then do it over and over and over and over. And then you'll say, oh, the market's rigged. You can't make money in it. There's something wrong. It's not made for the little guy, and all that other BS that people say who constantly make really bad decisions. So I'm here to break the cycle, to help bring some accountability to you. But the bottom line is, until the Federal Reserve sees that inflation is maybe not under complete control, but getting better, more under control, we're going to have these fits and starts in the stock market. And it's going to be tough to come by a really sustainable new bull market. And I think it's good in a way because we need people to finally give up hope. Every bear market ends after investors finally give up hope. They finally say, this is it. This is never going to work. The stock market's never going to come back. We're never going to see interest rates that low again. That's what drove the whole thing. I'm out. We need enough of you to do that. I mean, not you and me, but we need enough people to do that to finally get over the hurdle. All right. And that really, in a nutshell, is what's going on. Let's take a quick look at some of the stocks of the day. During regular trading, put this up. NVIDIA was up over $10 a share, up 6.5%, which is fine. That's a stock that has gotten absolutely crushed this year. Semiconductor stocks across the board today did pretty well. The sector's caught a couple of upgrades. Some specific individual names have caught some upgrades, all mostly on the back of electric vehicles, EVs. And the EV market is really starting to heat up. The charging companies, the semiconductor companies, it seems like they're all heating up except for Tesla. But Tesla is a whole other ball of wax. And basically Tesla helped create the market, but the market looks like it's going to be taken away by everybody else. So that's what's going on there. The next one I want to take a look at is, and this is in aftermarket trading, is Lululemon. Lululemon was finally looked like it could go back to its old highs, get smacked down $30 today. They beat numbers today. They had earnings today, earnings announcement after the close, good numbers, but their forecast for the current quarter came in a little light. Why? Because they see the consumer slowing down. Now, the CEO of Wells Fargo yesterday said he sees this consumer slowing down. Look, if everybody just spent 5% less money, the economy would go into a horrible recession. People are spending a little bit less money on certain things, and it's, you're going to cut back on Lululemon probably before you cut back on the stuff that you'd buy at the supermarket. And that's exactly what's happening. All right. And then that's aftermarket down 30. Okay. Down $30. It's a big drop. And then for a big up day, though, is DocuSign. This was a pandemic darling. If you know about DocuSign, you know how amazing, wonderful, incredible the service is. I use DocuSign every chance I get. I wouldn't leave home without it. It's just a great way to send documents to people, documents that need to be signed. Okay, with in a way that is as acceptable as a wet signature, like as if with a pen. All right, they're binding. When you sign a DocuSign, it's a binding agreement. There's no getting out of it. And I thought that would be one of the stocks that could stay a winner after the pandemic. But boy, oh boy, was I wrong. That one did just as bad as almost every other pandemic stock. But all of a sudden, it's acting a little better. It's up. It was up about 7% before. Now it's up 3%. We'll see what happens tomorrow. But the numbers were good, and I do think DocuSign is the kind of company that once you use it, you'll never go back. Is it a one-trick pony? Can they do something else besides documents? We'll find out. That is one of the things that I am kind of against right now is one-trick ponies. I'm really looking for more diversified investments, companies that have their hands on a few good sectors at the same time. By the way, diversification when it comes to investing is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. I got all that in like one sentence. I hate having to say that, but I'll do it anyway. Let's take a look at the overall market. So the Dow is up 183. Okay, not bad. NASDAQ up over 1%. S&P up 0.75%. Pretty good, up 25, 26 points. It's up 30 points just about in S&P. We have gold up a little bit. Gold finally, it's above 1,800, which we haven't, we don't see too often. Oil continues to go down at 71. So if you're wondering why your Exxon Mobil, your Chevron, your ConocoPhillips, those are getting squashed because oil is now like the lowest it's been even before. I think even before the Russian invasion of Ukraine. We are probably very close to see gasoline in a lot of places below $3 if you haven't seen it already. I know what you're thinking. It takes, the price of gas goes up so fast when oil goes up. When oil goes down, it takes a little longer for gas prices to come down. I hate that. U.S. 10-year Treasury up a little bit, still at 3.5%. The VIX is 22. Overall, I have to say, the day just ended up to be a pretty quiet day. Nothing major, no major moves. I like today's moves because I like smaller up moves. I don't want giant, 5% up moves in a day because they just get repealed so quickly. All right, let's take a look at bonds, and then we're going to get going. Bonds were mostly higher across the board. The 6 month, the stuff that you want to buy, okay? The 3 month, listen, a 3 month bond is 4.26% now. Not bad. And keep in mind, you don't put $100,000 into it and in 3 months get $4,000. It's annualized. So you get a quarter of 4.26%. So you get like 1.256%, something to that effect, okay? The 1 year 4.6. But anyway, yields moved up, but once you get past the 3-year yield, everything is below 4 all the way out to the 30-year. And what this is telling you is that when short rates are much higher than long rates, like they are now, it typically means, as an inverted yield curve, we're heading into a recession, loss of confidence in the economy. And it also tells you that inflation is not really expected to be a problem long term. That inflation is really more of a short-term phenomenon as opposed to a long-term one. So that is about it. I'd love to talk about a couple of other things, and I'm thinking about maybe talking about, talking about pandemic stocks, like stocks that were over 100, which are now under 10. Well, maybe under 20, because Peloton is up to 12, but down from over 100. Carvana was a couple $100 a share. Now it's under 5. There's so many stocks like that, and people think they're going to pick through the rubble and say, I'll find one of these that could be something special. The odds of you picking the one that could be something special, again, is really low. And I'm not saying that you can't have a good bounce back in these speculative stocks that could short-term be oversold. But I think when you're doing that, you're playing with fire. And I think when you do that, you're really taking your eye off on the things that are important, the things that you have to focus on. Okay. So I'll see if I could pull up one more thing here before we end it. I'm kind of proud of how this came out. And I'm actually pulling up my LinkedIn portfolio, my profile. Okay, got it. Just going to show you something that I made, and I'm proud of it. I love my social media. Connect with me on LinkedIn. I post a ton over there. Okay, but here's my LinkedIn page. Here's the picture. Is the stock market going to go up or down next year? And that's my face, mildly annoyed. Got the bicep right there, but believe it or not, I didn't mean to put that there. It's just, I can't help it. It's just, these things just, they get in the way sometimes. All right. All right. I know Natalie, who's going to edit this, just vomited in her mouth when she was hearing this, but I'm having fun. Okay. Then I wrote, really? You expect me to know that? I wrote, I'm sincerely flattered that you think I'm smart enough to know. But I do know that the odds are up, because we asked the question, will the stock market be up or down next year? The odds are up because most years the stock market rises. The percentage gains of bull markets have always been higher than the percentage losses of bear markets. This is why the stock market has risen over the long term. We don't know in advance which specific years that the stock market will go down, even though it's typically a minority of the years that the market goes down. We just don't know when they come at us. It pays to be invested in a portfolio that you could stick with through both up and down markets, so you could benefit from the long-term growth potential of investing. If you chicken out during down markets, you'll miss the gains of up markets. You see I put the little chicken there? You see that? You see the little chicken over there, the chicken emoji? And lastly, I know most of us should gradually reduce the stock market portion of our investments as we get closer to needing our investments to meet upcoming financial obligations. Well, folks, that's got to be the most common sense thing you've heard all day when it comes to investing. And the fact of the matter is, we spend a lot of time digesting news, economic stats, and the fact is, everything is going to be okay, providing you give yourself enough time, enough space. And when you know you have financial obligations coming up in a year or two, there's nothing stopping you from moving that particular amount of money you have invested into cash, so you don't have to worry about a down market affecting your cash needs. You don't have to sell even more shares down the road to make up for the shortfall. I hope this is helpful. Thank you so much. I'm going to get going for the weekend. I'll be here tomorrow. I typically don't live stream on Fridays unless something totally crazy happens in the stock market. So hopefully it'll be a quiet day tomorrow and you won't really see me on the live stream, okay? So connect with me on LinkedIn and I will speak with you guys soon. Please subscribe to my YouTube channel, Client First Strategy. And until then, nice to see you. Here we go.